Welcome to this explainer. I am so pumped you're here today because we're going to tackle something that can literally change the trajectory of your life. We're looking at a roadmap, specifically the beginner's roadmap to wealth for 2026. Look, if you've ever felt like the financial world is just this giant, intimidating wall of confusing terminology, you are in the exact right place. Today, we're stripping all of that away. We're keeping it jargon-free, straightforward, and highly actionable. So let's just dive right in and get you ready to make your first investment with absolute confidence.
You know, one of the most common questions out there, and our financial advisor source hears this all the time, is simply, hey, I have some extra cash sitting around. How do I actually invest it and make it grow? And honestly, it makes total sense, right? You work incredibly hard, you manage to save a little bit of money, and then boom, you hit a wall of overwhelming choices. There are just so many investment options, and half the terms sound like a foreign language. But today, we're going to translate that language and turn that overwhelming feeling into a super clear step-by-step plan.
But before we build wealth, we actually need to look at what happens if you do absolutely nothing. Let's get into part one, why your cash is shrinking.
All right, so why even bother investing? Why not just leave your hard-earned money safe and sound in a regular checking account? I mean, it feels secure, right? You pull up your banking app, the numbers are right there, and they never go down. But the reality highlighted in our source material is that if your money is just sitting there in a checking account, it is literally losing value every single year. The invisible culprit? Inflation.
Forget the boring economic charts for a second. Let's talk about lunch. Think about a Chipotle burrito. 6 years ago, you could grab one for what, about $8.50? Today, that exact same burrito is going to run you around $12. It didn't magically get 40% bigger. You didn't get extra ingredients for free. Your money is just buying less over time. That is exactly what we mean when we say your cash is shrinking. If you stuffed $8.50 under your mattress back then, it won't even buy you the same lunch today. To put a hard number on this invisible tax, think 2 to 3%. That's actually the Federal Reserve's target for inflation. They literally aim for the cost of living to go up by 2 to 3% every single year. So every single year you aren't investing, your cash's purchasing power is just quietly getting eaten away by that exact amount. Over a decade, man, that takes a massive bite out of your savings.
Okay, so we know the problem. Now let's look at the solution in part two, the compound interest engine.
Since inflation is actively dragging our money down, we need a vehicle, an engine, that pushes it up even faster. And historically, the stock market has been the ultimate machine for doing exactly that. Check out this historical average, 8 to 10%. While inflation chews up 2 to 3% of your money's value, the stock market has historically returned about 8 to 10% a year. So when you invest, you're not just trying to make a quick buck. You're mostly just helping your money outrun inflation. You're outpacing the rising cost of those burritos for sure.
Now, to put that into perspective, let's watch the math actually play out. Imagine taking just an initial $1,000 investment and letting it ride for 20 years at a 10% return. It balloons to over $6,700. You didn't even add another dime, you just let the engine run. This is the absolute magic of compound interest. Your money makes money, and then that new money goes to work and makes even more money. And our source makes a huge point here. Time is the secret sauce. The earlier you start, the more this compounding magic goes to work for you.
But wait, with all the crazy options out there, why focus on stocks? Well, first off, they're liquid. That means if you really need your cash, you can generally buy and sell them pretty easily. Second, they're incredibly accessible. Literally anyone can get started right from their smartphone. And third, as we just saw, they offer really strong long-term returns. They're just the most logical vehicle for a long-term growth strategy.
All right, let's pivot to the what. We know why we need to invest, but what exactly should we be buying? Let's explore part three, stocks, funds, and diversification.
This is exactly where so many beginners completely freeze up. They're terrified of picking the wrong company and losing the whole shebang. And hey, that fear is totally valid if you're taking the wrong approach. On one side, you have individual stocks. Our financial advisor source notes that picking those, it's pretty risky. If you bet on one company and they have a terrible year, boom, your whole investment takes a hit. But on the flip side, we have broad index funds and ETFs. These give you what we call instant diversification. Instead of putting all your eggs in one basket, you're basically buying a tiny sliver of all the baskets at the exact same time.
Let's clear up the jargon real quick. An index fund, or an ETF, take a popular one like VOO, for instance, is just designed to track a whole index, like the S&P 500. So when you buy a share of a fund like this, you aren't just buying one single company.
You are literally getting a piece of ownership in the top 500 US companies, all at once. It's the ultimate beginner's hack. By owning a tiny piece of the 500 biggest players, you spread out your risk and you just ride the general upward wave of the entire market.
Okay, we've got the why and the what. Now, let's get into the how. Welcome to Part 4, your 2026 action plan.
We're going to break this down into a totally doable, step-by-step playbook that you can actually execute this week. Step 1, open a brokerage account. Our source recommends sticking to the established platforms. Think Fidelity, Charles Schwab, or Robinhood, just to get started. Step 2, strongly consider setting up a Roth IRA. That's a specific type of retirement account packed with massive tax advantages, letting your money grow tax-free over time. And finally, Step 3, start dollar cost averaging.
Let's pause on that last phrase, dollar cost averaging, because it is a total game changer. All it means is investing a fixed amount of money on a regular schedule. Say, I don't know, $100 every single month, completely ignoring what the market is doing. Why is this usually the absolute best strategy for beginners? Because it takes all the emotion out of it. You aren't sitting there sweating, trying to guess if the market is high or low today. You just stick to your schedule, reduce those emotional decisions, and buy consistently over time.
Now, as you roll this plan out, you gotta know your own risk tolerance. Generally speaking, if you're younger, you have way more time to recover from any market dips, which means you can probably afford to take on a little bit more risk. But honestly, no matter your age, the absolute key to this entire roadmap is consistency and just time in the market. It's never about timing the market perfectly, it's about giving your money the time it needs to compound and do its thing.
So there you have it. You've got the complete foundation to start investing with absolute confidence in 2026. The next steps, those are up to you. Open that account this week, start small, and stay consistent. But I want to leave you with one big, provocative question before we wrap up this explainer. When are you planning to make your first investment? Seriously, don't let this just be another thing you watch and forget. Take action. Drop a comment below with your game plan, and let's get that